Hi, everyone. Welcome. As investment in DeFi has continued to grow, the metrics for identifying successful DeFi projects may differ for retail versus institutional investors. Complicating matters for investors are ongoing regulatory questions, threats, and risks related to security breaches and scams. In the last year, it's been reported that DeFi rug pulls and exit scams formed 99% of all crypto fraud in 2020. DeFi-related hacks now make up more than 60% of the total hack and theft volume in 2021, a large increase from only 25% in 2020. Before we dive into these questions, let's go through a quick round of introductions. I'm Karen, and I founded Blockchain Intel to identify fraud on blockchains through analytics. Earlier this year, we expanded that mission and became part of AppDome. In addition to blockchain-based apps, we are now helping to provide threat intelligence and securing apps. With many investors exclusively using mobile apps to transact, we help cryptocurrency exchanges, banks, wallet providers, and app publishers in financial services and other industries to secure and preempt fraud. Now let's go around and start with Henrik.
Hi, everyone. So my name is Henrik. So I'm the co-founder of DH, and DH is a decentralized asset management protocol that is currently running on Ethereum, and very soon it will launch on multiple chains. I'm also the co-founder of mStable, which is a stablecoin and
interoperate.
And I'm the CIO of Apollo Capital, which is a leading crypto asset management firm in Australia.
Welcome, Henrik. Barney?
Hi, everyone. I'm Barney. I'm a co-founder of Vega Protocol, which is a protocol and sort of blockchain and sidechain to Ethereum and other chains, which is focused on high-quality, professional-grade and capital-efficient derivatives trading that's completely decentralized and non-custodial.
Thanks, Barney. John?
Hi, thanks for having me. I'm John Farjo. I'm co-founder of Lunar Crush. As we say, without communities, there's no crypto. We bring transparency to cryptocurrency investing by providing clarity around community activity. That looks something like us tracking a few million social posts a day and trying to understand as best we can what's being talked about.
Thanks, John. And Tom.
Hey, everyone. Tom Shaughnessy here. I help run Delphi Ventures. So we're a venture capital firm. We also have a research division and a labs division. I've invested in 40 or so names. We have a keen focus on helping projects with token econ and strategy and their exposure. Hilariously, I just recorded with Barney yesterday, and he's a portfolio company of ours, so super excited. Thanks for having me.
Great. So for you guys in your retail and institutional hats on, what metrics are most important? Liquidity in terms of total value locked, token balance changes on exchanges, or price to sales ratio, or adoption metrics such as growing unique address count, or inflation rate? Which metrics are what you find important to first retail and then institutional investors?
I'm happy to start, if that's okay. So, I think you really need to dig into the numbers a little bit behind some of those metrics, right? So like a few years ago, we saw some blockchains having very high transaction counts, for example, but some of those blockchains had like 0 or no transaction fees. So those could be easily manipulated. And I think the same goes for some of the metrics in DeFi as well. So TVL, for example, is a very popular metric, firstly, like a high TVL could mean that the project is actually highly capital inefficient. So, for example, very high collateralization ratio means that the TVL will be high, but that's not necessarily a healthy protocol. In some other cases, you can see a kind of TVL be boosted by deploying non-working capital, if you like, to boost that metric, just like transaction count was boosted on some blockchains. So you really need to look at how the TVL provides value to the protocol. And I think the same goes for other metrics as well. So like trading volume is another popular metric for DEXs, for example. But then you need to keep in mind that order book DEXs are very different from AMMs, for example. So if you have an AMM, the only way to update the price of the AMM is through trading. So that will kind of, by pure arbitrage, lead to a lot of trading as the prices move in crypto. So it's not really comparable to order book AMMs. So I think you really need to look beyond some of the headline numbers here. And when it comes to early stage DeFi, I guess growth rate will be the most important metrics. So like growth of capital committed, activity, growth of users, and so on.
Yeah, cool. I agree with a lot of that. I think I certainly think it's very easy to have headline metrics that are maybe sort of vanity metrics like TVL, where you can kind of, especially in crypto where we are now, where crypto is kind of serving the needs of crypto people. And one of the things we sort of thought when we started Vega was we were very interested in building things that could be used outside crypto and could be used in the same ways that finance is used in the rest of the world. And so we look a lot at capital efficiency particularly, and we also look a lot at like cost per trade. And so when you look at the TVL and how efficiently that's deployed, but also when people access liquidity, what does it cost to access that liquidity versus what it would cost in alternative systems? We look at optimizing for those things so that the people who are the ultimate end users of this stuff in 2, 3, 4, 5, 10 years time are getting value for money and getting something that's actually a useful product.
Yeah, I jump in there. I definitely agree with Barney. Oh, sorry, John. After you.
Go for it.
Oh, awesome, thank you. Yeah, no, I definitely agree with the other panelists here. I mean, one thing I would say is past life I worked on Wall Street, and I kind of miss how we could update our comparables every day and quickly and easily compare metrics that mattered for different sectors, whether it be a certain cloud segment or the carriers. It made life a lot easier, but that was a very mature industry. I think that crypto is nowhere near the spot where we could compare metrics easily or dig into any type of comparable fundamental analysis. I just think it's still too early. What I do think, or what I would point people to, is you really have to find out what is important on a project by project basis. So, I'll throw a couple examples out there, but something like a cross-chain exchange like Thorchain, Disclosure We're Invested. I mean, something like that, the amount bonded on the security side in Rune and value is extremely important because it has to secure the network, and the amount in pools is different. But if you look at something like Uniswap with concentrated liquidity, you might not need as much liquidity as you need on, say, SushiSwap. So if you compare the TVLs there, it's going to look unbalanced, but in reality, you have two very different stories. So I would just say that I would spend the time to figure out what metric is important per project, and then just track the growth there.
Yeah, I think on the TVL side, I think one thing that's really that we look at is the velocity of that. How long has it taken them to achieve a certain amount? And I think there are certain narratives out there. One that's hot on my mind because we just talked to them recently was QuickSwap, which built on Matic, and it took them a whole month to get $1 billion in TVL from zero. So I think that there's things like that to look at. But I mean, from our standpoint, what we love to see is the growth of unique individuals talking about these projects. If we see that it's just a few people talking about these things on social media, it doesn't hold well for a strong growth going forward with TVL, with people using the application or anything like that. So we love to see a very broad-based group of individuals that are frequently talking about these projects organically. And this doesn't mean hiring a few influencers. This means that looking at the actual users that are posting of these applications and watching that velocity increase and expand. So we look for that a lot.
Yeah, and so are you guys seeing a difference between the retail investors and the institutional investors? And I would say even, you might have some traders in there that are not necessarily institutional, but they're certainly taking advantage of the decentralized exchanges and DeFi right now. So what are the differences that you're seeing in these investors, and how does that translate, if at all, to the metrics?
That's a hard question, I think. But I think Perhaps institutional investors are a little bit more long-term, perhaps. Maybe they're looking more at the team, if they're able to deliver kind of over time, if they're able to pivot if necessarily. Like we have seen projects like Land, which is now called Aave, and Haven, which is now Synthetics, take off. I mean, they didn't take off for some time, right? But then they had to pivot, and now they're very successful. And I think there were some institutional investors that were early into those projects. They saw the potential of the team, and I think maybe that's a differential factor. But I'm sure there are plenty of retail investors that are long term as well, and looking at these metrics. But I think in general, crypto markets are fairly inefficient. So doesn't matter if you're institutional or retail. I think it's possible to outperform if you do the fundamental work and look beyond the memes.
Yeah, I think this first thing I'd say is there's something you have to distinguish between investors in the token and investors as in users of a protocol. So there's a difference between someone who's going to buy the Uni token as an investment because they think that protocol will grow, and someone who thinks they want to use Uni for their day-to-day trading as an institution. And that's quite important, because I think you get institutions who would invest in a protocol because they see it growing, but they couldn't actually use that protocol in their day-to-day trading, for instance. And then the other big difference that I see is the scale difference, and that's effective. Like if you're a retail trader and you want to put a trade on that's $1,000, $5,000, something like that, it's relatively small. You can get involved in a protocol which has relatively low TVL. You can get in without moving the book too far. Whereas if you're an institution deploying $50 million of capital or more daily, some of the opportunities that look great are no longer great if you can't actually get in any size that's useful to the institution. So I think one of the things we see is just the time at which you get in as an investment, as an early stage investor, as an institution like a VC, versus the time at which you can actually usefully trade on the protocol as, say, a trading institution. That just depends on when that's ready and when it can offer enough liquidity and enough sort of low enough slippage, and also risk management comes in again. A completely new protocol which is untested. As a retail person, you might be like, yeah, I'll put $500 in there, and if I lose it, I lose it. Whereas as an institution, you've got to talk to your LPs and explain why you got hacked or rug pulled or whatever else and lost this portion of your portfolio. So there are just different forces at play which affect the sort of stage at which you're willing to get in, I think.
The question's on the difference between the institutional and retail investors. I missed the beginning, sorry.
Yes, question is difference between retail and institutional.
Got it. So I mean, we're basically focused on early stage venture deals, but what I would say is I think there's a pretty big, probably a huge gap in the traditional institutional investors and the on the ground crypto investors. I think a lot of the institutional investors, the traditional ones, are just getting smoked, buying these horrible deals that their traditional friends pitch them, and they're just so far from what's important in crypto that I think they're going to lose a lot of money, and the native crypto investors are going to outperform. As for Barney's point, I totally agree. I mean, the other thing I would add there is the big difference between retail and institutions is the retail side is investing their time and their brand and their know-how in these projects, and they're getting rewarded for that through things like retroactive airdrops and yield farming. So retail doesn't even have to invest money. They just have to invest their time and their interests and their, quote, investors. So I think there's a big difference between the retail and the institutional side. And I would just close to, agree again with Barney there. The large investors in the space, the large traditional ones, are going to have to allocate to liquid crypto assets. There's just not enough room on the private side deals, whether it be a private deal or whether it actually just be allocating as an LP or actually using the project itself.
I think, and Barney was kind of getting at this a bit, but like it's early for institutions. It is early. I mean, the amount of liquidity out there with what they're going to require, it's barely there. And they're barely playing in most of these assets. So I think it's really early. I look at that as also a massive opportunity going forwards. But I think, on the retail side, they're looking for user experience. They're looking for trust. They're looking for working with a brand that they understand. Like Uniswap has a brand. I'd say on the centralized exchange side, like There's a reason a lot of people, especially in the United States, start with like a Coinbase because they just recognize it. And I think the space is searching for that leader, that leading brand. And I think we're in the early stages of some of these projects becoming actual brands. And I think, consumers latch onto that. And so I think we're going to see a lot more marketing from a lot of these solutions out there in a crowded space. So I'd say look forward to that.
Okay, so let's switch gears now. I know we've talked a lot about what would make you invest, or what would make a institutional investor look at a protocol or a project. But let's talk about the risks, right? We often don't talk about the downsides, and it's important to discuss certainly the recent developments from regulatory bodies. And in a June 8th speech, the commissioner asserted that that unregulated platforms, in particular DeFi platforms, raise customer protection concerns because they may not monitor for threats, fraud, prevent money laundering, and safeguard deposits. And as we discussed before, there have been a number of recent DeFi scams, for example, rug pulls, where developers abandon a project and then leave with investors' funds. In addition, we have seen, and I have seen personally, many investors' wallets get compromised by hackers and millions of dollars lost. For example, we've seen wallets where the passphrase screen was easily altered by a hacker, rendering that wallet and all its users vulnerable. Also, malware that is supposedly installed to do contract tracing or things like that. Productivity apps will often be used to harvest credential data that is then used to illegally transfer funds. So the question is, are investors, retail investors as well as institutional investors, looking to preempt fraud and be proactive? Or are they largely reactive today? And what can they do? What metrics can they look at to address this issue? And as you answer this, would it be helpful for investors to have threat intelligence? Or better yet, preempt or protect from fraud and hackers? And what are examples of that you've seen?
Yeah, I mean, you of course have things like security audits, right? Or smart contracts. You have credibility of team and so on, right? But I think, personally, when I look at the security of something in DeFi, probably the Linde effect is the biggest factor here, and it's been said many times, right? So how long has the protocol been running safely for? How much capital has it protected for how long? So I think on some chains we've seen a lot of hacks recently. Maybe those protocols have been forked from Ethereum, and the developers behind them have not maybe a deep understanding of how the protocols work. And I think that's definitely a big risk. And those have been fairly new protocols on newer chains. But yeah, those are some of the things I'm looking at.
Yeah, and I agree with that totally. Actually, I think that those are all really good points. And I think to echo what Tom said in the answer to the previous question, actually, we're really early, and we're too. And this is another one of those places where we're too early. And what I mean by that is, when you look at traditional finance, I can guarantee you every major bank or fund has a security audit. I can also guarantee you the investors and the people who put the money in don't care what the results of the security audit are. And the regulators will check the results, and the regulators might pull them up on stuff. But actually, the way that the markets in the sort of traditional world work is they work on market-based stuff. So, for instance, we have CDS, credit default swaps is a good example. The CDS tells you how likely a company is to go bankrupt. And if you want to know how an asset's going to perform, you don't get someone to write up a 30-page report on the security. You go look at the market and see what the market says about how likely this thing is to default. And I think, especially in crypto, where everything is dependent on code and everything is sort of market driven and everything is decentralized, you can't have a government that's going to insure, the FDIC sort of insurance type stuff. You need to rely on a market, because you're not going to get the right stuff out of just kind of people doing some audits and getting some reports. And I think, as Henrik said, the how long a protocol's been alive and not been hacked, and those things are good metrics and useful stuff. But I actually think until we have, and some of the sort of on-chain DeFi insurance protocols are starting to do this, until we basically have a price that you can look at and go, well, this is giving me this yield, but for this yield, I'm taking this much risk because the cost to insure, 100 DAI that's in this protocol locked up is X. Until you have that and you can say, hey, what's the difference between the yield I'm paying and the risk I'm taking? Until you have a market for both of those things, you're effectively blind as a user of those protocols unless you're a kind of technical guru, and even then I think you're going to be in trouble.
The credit default swap one is interesting. It's kind of funny. I guess in our space that would be like the the cost to get cover on Nexus Mutual, where buying cover for urine is 2 or 3% a year or something, and buying something for like Alchemex is much higher, 20-30%, because it's newer, a little bit riskier, but it's secure. But I think everyone gets my point there. But I think a lot of people lose money on early stage yield farming. I mean, last summer was really DeFi summer, but you gotta weigh the risks on how flashy the website is, who the developers are they anonymous or not anonymous? If they're not anonymous, they actually have a personal brand to ruin if they screw people over. Is there an audit? I mean, most of the protocols that get hacked have audits anyway, so is that really worth it? You change one line of code and that audit is completely outdated. So yeah, to Karen's point, I definitely think threat intelligence is important, but it's all a spectrum. You have to have a different risk reward modeling in your head, depending on, I guess, the stage of where a project is, and getting into institutional security for funds, and having your entire Fort Knox of a system with multi-sigs and that whole thing is a whole nother conversation, I guess, for another time.
I think that there's certain best practices that are being formed, and we don't have best practices yet because it is so early. But I know that there's groups such as like Hackin out of the Ukraine that will audit different applications. A lot of exchanges use them. But I think on the consumer side, I'm going to give a different example. Let's talk about automotive. In the automotive space, you've got organizations like JD Power and Consumer Reports. Those give the consumer at least a head start because they've done an audit on every vehicle. Some of those vehicles get the car of the year, and people rush to the car dealerships to go buy them because they get car of the year because the work was done for them. And then what happens when they buy that car? They apply insurance to that vehicle purchase because they don't want to get a rug pull on buying a car. So I think that's a really good parallel to say, if I was participating in a DeFi platform, bake that into the user experience, make it an option. Companies like Expedia do this. When I book a vacation, I optionally can purchase insurance. Yes, it's going to cost me more, but there's certain protections that go along with it. DeFi is lacking this. And I think these are all opportunities. And I think until these are solved, it's kind of limiting the audience to a much more technical oriented individual versus more mainstream adoption.
Yeah, and just to drill into that a little bit more on the consumer side, especially as a lot of investors are using their mobile phones, right, their mobile devices to manage their transactions. In addition to this insurance, what about the security of the apps and the security of their private keys? How do you see the industry responding to that? Or is that something still early and yeah, is extremely vulnerable right now?
I think it just adds another layer. And if you sort of think about it, where we have these non-custodial protocols where you trust the protocol to hold on to your funds, and your wallet is just another bunch of code you have to trust with your funds. And so effectively what we're doing is we're just creating these different bundles of code that at different points in time are looking after your funds. And the same thing applies to your wallet. You might be using a really cool flashy wallet app that claims to do multi-sig, and you can recover by having like guardians or whatever and people in your network and all this kind of cool stuff. But if the fundamental app can leak your keys to an attacker somehow, then the whole of the rest of the security model is broken. And it's exactly the same problem as with a DeFi protocol. It's probably just that there's a slightly more understood problem space and security space because we've been working on it since sort of 2009, 2010 with Bitcoin, rather than sort of the last 2-3 years with DeFi. So we're probably a little more advanced and better further on in understanding the space there, but it's the same class of problem, I think.
Okay, great. So to end with, what are key metrics that you think investors aren't looking at and should be, or take it a different way, in the coming year or coming years? What do you think is going to change as the space develops? What is going to become more important for people to track?
Well, one thing I'd like to point out is, like, today you have real economic yield, right? And that will increase over time as projects mature. But today you actually have some of the projects that have been around for a while actually having a real yield that is, you know, comparable or exceeding the yield of you know, high dividend yield stock or something like that. And you combine that with a high growth in DeFi, which I think is pretty amazing. So look beyond kind of inflationary rewards and at the real economic yield that some of these projects are generating today. I think it's quite amazing, and we'll see more of that in the coming years.
I might be biased, but I'm going to say community activity. The correlations to adoption of these protocols, various projects built on top of them, price movement, TVL, all of it is talked about on social media, especially Twitter, but on a much more broad scale everywhere. If you're not looking at community activity, you actually have no idea how many people may or may not be coming into a project. All you're looking at is numbers, which are consequential. People that are coming into these protocols, they almost all talk about it. They can't stop talking about it. And a lot of that goes along the lines of, you know, a lot of these individuals in crypto are almost borderline religious. Look no further than Bitcoin, look no further than the Ethereum development community. People don't stop talking in this space. And just as an example, a year ago where there might have been 200,000 posts a day, there's now up to 2 million. The whole space has grown 11 times in the amount of unique individuals talking about crypto over the last year. So we expect that to continue to grow. So it's also why we're very bullish on the space right now, because it has not gone down. So I think that's going to be very important to look at going forwards.
So I think the big one for me is capital efficiency. I think that people are going to start looking at the efficiency of the deployment of their capital. And I think Uniswap with V3 have fired the starting gun there. When you look at the stats for the value locked versus the amount of trading it's facilitated, what you realize is that that's going to become super important. And I think that's just only going to get more and more competitive. So I think that's a big place. And then the other two things I think of: scalability, so kind of the ability to scale up to larger size and more people entering into a given protocol, and the sort of sustainability of yield. And, you know, what we're seeing at the moment is, if you can sell a bunch of tokens for loads of money because you've got a sky high valuation, then you can give that money out to people and you can kind of fund things to keep going. But you've got to have a sustainable yield. And so one of the things we're going to start to find out is which protocols are offering a yield that's going to keep going after the money runs out, or after issuing the tokens is more based on the fundamentals than some kind of crazy valuation, and which ones can't. And I think, you know, sort of sustainable yield and high capital efficiency alongside that are going to be the things that give you the standout protocols versus the rest.
Yeah, I'd say Barney hit it on the head. Capital efficiency is obviously extremely important. And I do think, kind of to echo my earlier answer, just a project by project basis, understanding what metrics are important is really valuable. But also to echo Barney's point, I mean, last summer was insane with yield farming. These projects were obviously in and out of biz in 24 hours or 120 hours, you know, pick your kind of metric there. We're starting to see projects launch and get significant adoption without launching yield farming incentives, which is kind of interesting to kind of see. There's a couple of examples of that, but I mean, if you look at Thorchain, you look at Zapper, you know, Gitcoin before the airdrop, things like that, super important. So you're starting to see kind of a normalization of that, where products are finding product market fit beyond people just chasing a yield. But we're also trying to keep an eye on any new metrics we can track. Like for NFTs, we want to see them get better pricing through things like fractionalization and things like Upshot, where people can actually price through the will of the crowd. So there's a lot of things we're looking for, but yeah, we just want to see the space mature.
All right. Well, thank you guys. It's been a pleasure talking to you, and thank you for your wisdom and your thoughts here. Hope to speak to you again, and hope you stay for the rest of the conference. Thank you very much.